bought a Tesla Model X or the Mercedes G-Wagon, which is, especially if you're on Instagram, a lot of people buy.
Sure.
And so if you bought one of those and you want to see how you can actually write this off.
Yeah, I've had clients that have deducted the entire cost of their car in 1 year if you meet certain requirements.
Welcome to Office Hours by Fujikawa Associates. We're your hosts, Josh Baldovino, and I'm a real estate investor and one of Derek's clients. Derek is the managing partner of Fujikawa Associates. Derek, how are you doing today?
Good, thanks. How are you doing?
I'm good. So I am really excited because I have a million questions about write-offs, and I know that's probably one of the most frequent questions that you get from some of your clients, I would assume, right?
Yes, quite a few.
And write-offs, deductions, someone says, oh, you can just buy this because you can write it off. Let's just dive right into it. What does that even mean?
Write-off is something that you can take against your taxable income and reduce that to get to your taxable income, which you then apply your tax rate to. Say you have a business, you bring in a gross income of 100,000. Any expenses that you have against that income would be a write-off, or would be a deduction against that 100,000. Say you had $100,000 of income and $40,000 of deductions, then your net, assuming that they're all deductible per the IRS rules, your net would be a $60,000 taxable income that would go on your tax return.
So they automatically take off the top so that you are reporting that you have less net income.
Yeah.
Write-offs and deductions, are they interchangeable or do the definitions differ at all?
They're essentially the same thing. There are some deductions that you technically can't write off or are limited in terms of write-off. For example, business meals. You can deduct your business meals, but you can only write off 50% of them. So if you have a $50 meal with a potential business partner or client, and it is truly a business deduction, then you can deduct that from your net income, but on the tax return, it gets cut in half by 50%. So you'd only get a $25 write-off versus a $50.
How does that differ if I'm paying for the business meal from my business credit card versus my personal credit card? Does that 50% only play into play when you are doing it on your personal card?
It has to have a business purpose. If it's a business purpose, then it is 50% deductible. If it's a personal meal, then that's non-deductible. It doesn't necessarily matter where the expense is coming from.
So if I'm at a restaurant and we had a business meeting with some potential investors, we paid for the check, I should be using my business card for that.
You should be, for record-keeping purposes. As a sole proprietor or Schedule E, it doesn't put you in any trouble using your personal card. It just makes it a little harder on my end to separate things out and make sure that they are business versus personal. The important thing is to document it. The best thing to do is save the receipt, and on the back of it, just write down who you met with and just a quick one-sentence line of what was discussed. Because if you're ever audited, they are going to want to see those receipts and what was discussed. And if they audit you 2 years down the line, you're probably not going to remember off the top of your head.
So in terms of documenting meal expenses, you either write it on the back, or I'm sure you take a picture of it, scan it into whatever system you have, and then maybe you annotate.
Yeah, even better.
You just need that info.
Yes.
Do you have any favorite software recommendations in terms of if someone's a DIY bookkeeper?
For meals, I haven't found one in particular that I use. If you use QuickBooks, they have a receipt scanning add-on where you can attach the receipts to either credit card or invoices, and allows you to track things there. But I haven't found a separate standalone app yet.
In terms of just documenting expenses in general, what is your go-to recommendation for business owners?
Documenting is key with everything. If you have a software that you're comfortable with, that's always the best one. If you haven't used one before, I usually recommend QuickBooks. It's pretty user-friendly and pretty easy to use and connect it to your bank accounts and things like that. That's one that I recommend, but really whatever you're most familiar with, as long as you just keep track of everything and have everything documented.
I'm just curious, as we're thinking about bookkeeping and a CPA, what are the differences there? We define each of those jobs.
A bookkeeper is someone that keeps the books. They're going to take your transactions, they're going to look at your bank statements, your check registers, your credit card transactions, and put it all together and create a basic financial statement, your profit and loss, and a balance sheet for you. And that's pretty much the extent of what they'll do. So that's just the nuts and bolts of putting it all together. The difference between a CPA and say just another accountant, like an enrolled agent or anyone else. CPAs can sign financial statements. so they can give an opinion and give an assurance on a financial statement. So that's one thing that we can do that no other accountant can do. And then also, we just have a little more experience and we can analyze the financial statements a little more than just putting it together.
Would you say that CPAs are fiduciaries? Are bookkeepers as well?
Not necessarily. They're basically just taking information that you give them and compiling it and putting it into a format that's a little more easier to understand. But I wouldn't necessarily say they had a fiduciary duty.
And so in order of operations, as you have seen hundreds, if not thousands of businesses, what order of engagement do businesses now start to come into your funnel? Are they bookkeeping first, CPA filing first, and then going more into strategy? How does that workflow usually look like?
It varies. We're trying to funnel it in a certain way, but I guess the vast majority of our clients come in for their taxes. They'll have a need for their tax return. We'll work with them and on planning and strategy and things like that from there. Some will come in, they have some questions during the year and they'll want to strategize for their tax return. Maybe they're doing it themselves, but want to strategize. And from there, oftentimes we'll build a relationship and we'll end up actually doing the return for them. But it just depends on the client and how involved they want to be in the process. Then we do have clients that come in with strictly bookkeeping needs. And then from there, we hopefully expand on that and we'll work towards doing the whole package for them.
I feel like most people, regardless if they're a business or just an individual filing for the taxes, they know that every single year they have to file.
Yes.
And so that's seems like the low-hanging fruit in your industry. And then on top of that, as things get more complex, keeping the books and really strategizing ends up being the next and the highest level of that.
Yeah. And like TurboTax is a great program. It's easy for someone with just a W-2 income. But once things get a little more complicated, if you have rental properties, small business, stock options, or things like that, then I found that there's a lot of room for error there with the do-it-yourself type of software programs.
That makes a lot of sense. Let's dive into really the nitty-gritty of what the episode's about, and that's write-offs and how to best utilize them, what may be available to business owners. And so let's just go into some of the common ones that people hear about. It's timely because Apple just had their event with the new iPhone 14 coming out. How can someone write off their phone?
There's a few items that the IRS considers, it's called listed property, and a telephone is one of them. With those, you need to actually document your use. And if it's more than 50% business use, then you can deduct the cost of your phone plan and the cost of the phone and everything. If it's less than 50%, then you have to prorate it and only use your business use versus your personal use.
And then in terms of documenting the use of the phone, is that just most people just have a spreadsheet? Or
yeah, that's the hard part. Who keeps track of their time on their phone? You do need to try and keep track of it. You highlight your business calls and use that percentage there. Keep some sort of log and just track that if you want to deduct the cost of your cell phone.
And that's the device cost plus a service plan.
Yes. And you have to be careful. Oftentimes you have your whole family on your plans. You have to separate out your phone that you use for business, not versus the entire bill.
Another common one, and you see this probably all over social media right now, it's writing off a car. What's the wrong way to do it and what's the right way to do it?
The wrong way to do it is just not document anything and just write off all your gas receipts and all your repairs. With auto, you really need to document very well and only write off your business use of a car. So you buy a car and you use it for business, you take it to clients, take it to job sites, things like that. Then you can deduct the business use of that car. There's two ways to do it. There's a standard mileage rate and an actual expense. Both ways, you still have to track your mileage, but you also have to track your total mileage for the year. Say you drive the car 50% for business. Say at the end of the year, you drove 10,000 miles and 5,000 of it was business after you added up your journal. Then there's two ways you could do it. You could either take those 5,000 miles and multiply it by the standard mileage rate, which currently this year they just upped it to, I think it was 62.5 cents per mile, which is pretty substantial. It's more than just the gas if you multiply that out times the miles per gallon. And that kind of takes into account wear and tear, insurance, repairs, things like that. So you can use that. That's a simple way. That's the easy way. You can just multiply that rate times your total miles, and that's your deduction on your return. Or you could take your percentage. So in this instance, if you had 5,000 miles and 10,000 total miles, but 5,000 business miles, then 50% of all of your expenses you can take as a deduction on your return. So you can add up all your gas bills, your repair bills, if you had to replace the tires or things like that, add those all up and take 50% of it, as well as depreciate 50% of the car. And you can compare and see which one gives you the better write-off.
So is the depreciation of the car only available if you do the second option, or is that also available for the first option?
Yes, only for the second option.
So if you either almost a straight line depreciation, the house, or you're itemizing it.
Depreciation for vehicles, there's a number of limitations on them, but you do get accelerated depreciation on it.
Okay.
And so it's over a 5-year period. And so most of it is front loaded. So you can take more of it up front. However, there are some limitations.
If I'm using the car for business purposes primarily, and I got a Tesla Model X, which is one of the cars that a lot of people get for that specific
Yes.
particular depreciation. If you bought a vehicle and you want some specific info, this is where you contact Derek. I know there's probably some specific questions about, hey, I bought a Tesla Model X or the Mercedes G-Wagon, which is, especially if you're on Instagram, a lot of people buy.
Sure.
And so if you bought one of those and you want to see how you can actually write this off, if you can, make sure to click the link down below, book a call with Derek, and he can dive into your situation specifically. Cars are really fun. Do you have an example of someone who did it?
Yeah, there's a number of examples of clients that have bought 6,000 pound car and were able to write off the entire amount. You buy a $50,000 car, you take that right off the top off of your taxable income and take that as a write off. That's always fun to be able to take that big of a deduction.
And I guess that's maybe a little timely because a lot of people, when they're filing, they try and say, oh, my CPA didn't tell me beforehand. As the calendar year ends, that's also when you can stop putting any actions in place, whether you're making investments, allocating income, having expenses. What are you advising some of your strategy clients to do?
The best thing to do is start looking into it now. The hardest part is when a client comes to me in February and asks what they can do. At that point, there's not a whole lot. There's a few small things, but not a whole lot that we can do that it can make a significant impact on the tax return. Between now and the end of the year is a great time to start planning at the end of the year. I never tell clients to spend money just to get a tax deduction. That doesn't make sense. To spend $1 and at most save 50 cents in taxes. So you're still out that 50 cents, right? So you're never going to be better off spending money you don't need to spend just to get a tax deduction. But if there are things that you do need and it's going to be a high income year, then, we can accelerate some of those expenses into this year, maybe purchase a capital asset, a vehicle or some sort of equipment that you need. Or conversely, if this is a down year and you feel like next year is going to be a better year, then maybe we defer some expenses to next year. We don't take as many expenses because we don't want to take those against a low income year. We want to move those to next year and take them against a higher income year. So there's a lot of things we can do to look at everything and minimize your overall taxes between the 2 years.
So that's a friendly reminder. If you're watching this and you have a couple months left and you know that you either had a really great year or you have a better year next year, now's the time to either talk to Derek or to your CPA as just a friendly reminder. And maybe then you can actually have a decent Black Friday then or something. What about a home office? That's one that I'm sure you get a lot of different questions about and you hear a lot of different advice on. How does someone write off a home office?
You do have to have a business for home office. The IRS did away with employees having a home office. It fell under miscellaneous itemized deductions, which the IRS got rid of a few years ago with one of their tax laws. You can do it if you do have a business. It does have to be a dedicated business space. In the past, it had to be a actually specific room. They have eased that a little bit where it can be a space in a room, but it does have to be a dedicated area. So it can't be like your gaming system and your work computer all there together. It does have to be a dedicated workspace. And you'll take that percentage, that square footage that you're using for business, and divide that by the total square footage of the house. And that percentage, you can take that ratio and apply that to all of your household expenses. Your mortgage, interest, and property taxes, which are normally deductible as itemized deductions, you can pull some of that into your business expenses, and then other things that aren't normally deductible, homeowners insurance, utilities, repairs, maintenance, all those expenses, plus the cost of your house, you can depreciate over 27 and a half years, the percentage that you use for business. So it can be a nice deduction to take depending on the size of your house and the size of the area that you use for business. There's also another method where you can use, if all of the rooms in your houses are about the same size, you can use what's called the number of rooms method, where say you had 10 rooms in your house and you're using one of them for business, then you could take 1/10 of your total expenses as office in the home expenses to kind of simplify the calculation.
How common is that? Is this write-off for business?
It's getting more common just with COVID and people moving businesses back home and things like that. But it does have to be either your primary place of business or your primary place where you do your admin work. If you have a storefront, but you do all of your admin at home, then you can use that as a office in the home. But if you say have an office where you do most of your work, but then you come home at night and do some work, a little bit of work at home, that's not necessarily your primary place of business, so that wouldn't count.
What if I'm renting? Like, for example, for me, I'm renting an apartment here in San Jose. How does that work out?
So same thing. You take your business area, divide that by the total square footage of your apartment, and then you can deduct all of your expenses relating to that apartment. So the rent, If you have insurance, your utilities, everything that's relating to your apartment are deductible.
And then just some follow-up questions on this just for fun. So I'll just say that this is my home office. Right off the square footage, are there items as well that can be categorized as capital expenses or however you would claim that?
So office in the home is strictly your home expenses. So if you're buying equipment or anything that goes in that space, that's fully deductible because that's directly related to your business. Office in the home is more just all home related expenses. So the utilities, you use that for the entire house, but you can deduct the percentage of that area that you use for business as a business expense.
If I purchased a computer, this mic here for this, the lighting setup,
That's all fully deductible as a
business.
direct business expense. Yeah.
What about this couch here that I use for meetings once in a while?
You'd probably need to allocate how much you use it for business versus personal. If the kids are in there all the time watching TV or something on that couch, then it probably wouldn't qualify much as a business expense. But if it's a chair that you use just for clients to come in and use, then yes, that would be a fully deductible.
The other one that gets just a lot of gray area is trips.
Yes.
How can we actually make that a write-off?
There has to be a business purpose to the trip. So you can't just go somewhere and say it's a business trip and write it off. You can't just go somewhere and say, oh, it's a business retreat or whatever. There has to be a business purpose to the trip. And then you have to look at the number of days that you're there. So you can combine personal and business on a trip, but there are some specific rules. If you're just spending one day on business and 2 weeks on vacation, then that's probably not going to fly. You may be able to deduct a few things. You're not going to be able to write off your full plane ticket and your hotel and everything like that. But if you go somewhere for a conference and you're there for 3 days and you want to go an extra day earlier to spend some vacation, as long as your business time there is more than half the time that you're there, then you can deduct the full amount of the flight. If it's less than 50%, then you're going to have to prorate it based on the number of days that you're there versus for business versus personal. And then hotel would just be strictly based on the number of days that you're there for business versus personal.
I've heard another strategy, and I'd like to know how true it is, of the sandwich method. Is that?
Because the IRS doesn't consider the weekend business days. And so if you come on a Friday, or say you come on a Thursday, your travel day is a business day, you work on a Friday, and then you have Saturday, Sunday where you can't get any work done because they're not business days. And then you have a meeting on Monday, travel out on Tuesday. You've got 4 business days there. You got those 2 in between days that are not business days, but you've got those 4 days there now around it that are your business days. So you can show that your majority of time was business. But you do have to be careful. You want to schedule those meetings for Friday and Monday. You can't just schedule a bunch of Friday meetings and stay until Monday and fly out. If you don't have a business reason to be there Monday, then you lose those days as business days.
So the rule of thumb is to always book Friday and Monday meetings, at least.
Yeah.
What are the other definitions or terms that people use to mean the same thing?
Capital expenses, like fixed asset is something that you would use or just an asset. So capital expense is something that has a useful life or an asset. So an expense is something that you would expend during the year. Expense, you buy a supply and you use that supply and it's all used up. You can't use it again down the line. Versus a capital asset or fixed asset like a refrigerator that has a useful life. It's not going to die. Something like that, the IRS deems it has a 7-year life. So you can write it off over 7 years. So you don't get to deduct the full amount of the asset in the year that you purchase it, but over time. There are some provisions that allow you to write off more or even all of it, but we can discuss that at a future time if you'd like.
Has there been anything that was extremely unique, off the wall, different, that a client you ever heard of or that you saw as a write-off? And
so speaking of vehicles, this was quite a while ago, but we had a client that bought a Hummer and they put their company name on the door and tried to write off the entire Hummer as a business expense because they tried to write it off as advertising, and the IRS didn't let that fly.
Not fly because he basically wasn't also driving it around as for work purposes?
Sure. It was basically his personal car. He just put his company name on the door or on the side of the car and tried to write that off as advertising. You have to use that car for business. It can't just be a moving billboard.
Say you are driving the vehicle for business purposes. Is there any other advantages to now having your face on the side of your Tesla Model X? Does that increase it? Does that add a different write-off, or is that basically the same if you're still driving it for the same purpose?
Not necessarily. And the cost of doing that is deductible, but you still have to keep track of your miles and keep track of the business use. Yeah, I've had clients that have deducted the entire cost of their car in 1 year. A lot of people didn't know that you can write off your entire car if you meet certain requirements. And I've had people that have tried to get away with a little more than they should on, especially with vehicle expenses. That's one that a lot of people like to play with.
I do want to add, like, writing off business trips. When you add your family, like you have a trust and your trust now owns the businesses and your family's part of the trust. Is that like an actual legitimate way to help write off some of your family's travel expenses or not?
So adding someone to a trust, not necessarily. That is more for like estate planning or legacy planning, not necessarily your day-to-day operations. Unless your business is within the trust and they're actually doing business or doing work for the business. But you just add them to the trust as a beneficiary or as a trustee. It doesn't necessarily create any deductions or any special tax.
So if I were to do that, say for example, we have our short-term rentals that are in various parts of the country.
Mhm.
If my wife is part of the trust, if the kids are part of the trust, my kids would have to be doing some type of work on the property for it to be regarded as such.
Are you referring to like living trust? Or what type of trust are you referring to? Since you have all these properties, this is a living trust. Now that you have assets and net worth, living trusts are something that'll help you avoid some potential issues later on down the line, and you eventually pass away or something happens.
And maybe I might just say there are other CPAs online that ride the line a little bit more loosely, because I'm sure that someone would want to know that you're taking more precautions than others. If you're watching this and you have any questions about trust, you can leave them in the comments down below. Is there anything else you want to add to this episode, Derek?
Just document. That's really the key when you're writing things off, is to document everything. The worst thing to do is try and write off something and get audited a few years later and not have any documentation, because that's a recipe for a big tax bill.
I will work on my own documentation. I hope you all who are watching this also do that as well. And of course, if you have any questions, make sure to book a call with Derek down below. For those in the audience, if you have any specific questions that you'd like us to approach in a future episode, definitely let us know in the comments below. We will take all of those into future episodes, and that way we can answer your questions specifically. And of course, better yet, you can always book a call with Derek. Derek, thanks so much. I'll see you guys on the next one.
Great.